Good evening, one and all. Welcome to our evening sessions for revision. So we are in the mid of this revision batch. We have done few topics and now post Diwali, we are resuming with the revision of our remaining topics. So I welcome all. And the topics that we are going to deal with today are mainly procedural based, but they also have relevance when it comes to your exams, the case study based questions, or even the MCQ based questions. So let us try to quickly revise them so that it is uh, refreshed in your minds. And if there are any questions, you will be in a position to tackle them comfortably. So starting with the first topic for revision today, which is registration. In the chapter of registration, as we all know, the basic thing that we are going to discuss is who is liable to register, by what date they are liable to register, and the other procedural requirements. So let us start some basics about registration. Firstly, that the registration under GST is PAN based, as we all know. Your registration number, which is a 15-digit number, has 10 digits copy paste PAN. So if you are having multiple registrations under the same PAN, that can be identified because all those registration will have the same 10-digit PAN number. But having said that, the second important thing is the registration is also state specific. Now, what do we mean by state specific? State specific means that whenever you are taking registration, the registration has to be applied for in every state. And as you all would be knowing, the 15 digits registration numbers, first two digit is the state code. So that helps in understanding that you belong to which state, that is, you are a registered dealer of which state. So that is the first point. Next, you need to compulsorily register in every state where you are having a place of business. Now, here I would like to clear one small confusion that if let us say I have my office in Maharashtra and let us say I am doing business in Maharashtra, in Gujarat, in MP, in Karnataka, and let us say in Kolkata. Then the question that comes is, do I need to take registration in all those states where I am making a supply? Answer is no. You need not take registration at all those places where you are making a supply. So place of supply is not the place of registration. Many times this is the confusion. People mix between place of supply and registration. Registration is to be done at the place where you are having your place of business. So if I am having my C office in Maharashtra, I will be registering in Maharashtra. Now this is what is important. Now in this, one more important point that you need to keep in mind is that if I am having office in multiple places, then every office from where I am making a taxable outward supply, I need to take registration once I cross the threshold. Now, if within the same state I have multiple offices, then whether do I need to take registration for every office in the same state? Here the law says it is optional. Means what? The law has given you the choice that if you want, you can take registration for each of your offices separately in the same state. Or second option is you can take one registration and cover all the offices in that one registration. Now, how this will be done? This will be done by taking one registration, treating one of the office as the principal place of business and the remaining offices as the additional place of business. So this you need to keep in mind that when you are taking registration of multiple offices in same state, one single registration, how that will be done? That will be done by considering any one of your offices as the principal place and remaining offices as the additional place. But this is possible only within the same state. If it is multi-state, this is also not possible. You are not allowed to take registration of multi-state one registration. That is not allowed. Next, a business entity having separate place, we have discussed this. GST identification number, also called as GSTIN, is a 15-digit number, and a certificate of registration incorporating therein this GSTIN is made available on the common portal after you are registered. Now, registration under GST is not tax specific. Means what? Now, we all know we have CGST, we have every state's SGST, we have IGST. So the question is, do I need to take 3 registrations? Answer is no. So registration need not be taken for every tax. So if you are registered for CGST, you are automatically registered for SGST, IGST all. So registering in one state, for one tax is equivalent to registering for all taxes. So that is what is important, that registration need not be taken tax wise. Okay. Now coming to who all are liable to register. So broadly, there are 2 categories of persons who are liable to register. One is section 22 and the other is section 24. Now 22 depends majorly upon the threshold. So the one who crosses the threshold have to get registered. This is what 22 says. What is 24? Those who are involved in some specific types of transactions or activities. Let us go to both of them. First, section 22. Now 22 has said that once you cross the threshold, which is 20 lakhs, which is 10 lakhs for special category states, and specifically where you are exclusively engaged in supply of goods only, it is even 40 lakhs in some states. So these are the thresholds, and this particular turnover has to be taken as the aggregate turnover, which is all India basis turnover under the same PAN. So under the same PAN, whatever turnover you are making, you will be taking registration on the basis of the total PAN-based turnover if it exceeds the limit. Now, while calculating this aggregate turnover, what all things will be added, merged to count this turnover? So all taxable supplies, if your supplies includes exempt supplies, which means which has nil rate, which is wholly exempt by notification, or which is even non-taxable, all 3 are included in exempt. Plus, if you are having exports, if you are having interstate, all your outward side supplies are included. What is not included is, let us say there are certain supplies on your inward side under which you are required to pay tax under RCM as a recipient, that is not counted. So even though those supplies you have to pay tax as a recipient under RCM, but since they are not your outward supplies, they are not counted as aggregate turnover. So very important point, aggregate turnover would include only the turnover which is applicable for the purpose of your business and which is only including your outward turnover. Then second is wherever there is a transfer of business on account of sale, on account of succession, or by virtue of amalgamation demerger. In both these cases, when the entire business is transferred from one person to another, in such cases also you need to take compulsory registration. If the transferor is a registered person, the transferee has to be registered. So these are the cases covered under section 22 which requires registration compulsory. Now, what are the thresholds? The thresholds are for those states which are under special category and those who have accepted the lower limit. For them, the limit is 10 lakhs. These states presently are Manipur, Mizoram, Nagaland, Tripura, though there are other states also like Meghalaya, Sikkim, Uttarakhand who are special category, but they have now opted for the general limit, that is the higher limit of 20 lakhs. So in 20 lakhs, you'll find the name of the other remaining states, which may be special category states, but they have opted for the higher limit. Then beside, there is one more limit, as I said, which applies exclusively for supplier of goods, where you are only engaged in supplying goods like small traders, grocery shops, etc. For them, again, few states have opted for even further higher limit of 40 lakhs. These states are Jammu, Kashmir, Assam, Himachal Pradesh, and other than the above. So these are the states who have opted for 40 lakhs limit also, but that limit is applicable only where the supplier is exclusively engaged in supply of goods. Now coming to section 24, these are the case scenarios where 24 applies, where you need to take registration on the basis of any of these triggering points. So here turnover is immaterial. Your turnover may be even rupee 10,000. But if any of these scenarios are applicable to you, you are compulsorily required to get registered. First, if you are making interstate supply, but here you have to read this with section 23, which is the section which is providing relief or exemption from registration. When you read combined this point with section 23, then the final result that comes out over here is person who is making interstate supply of goods. They are compulsorily required to get registered. If you are making interstate supply of services, you still enjoy the above threshold that we just saw. Then secondly, if a person is a casual taxable person, that is you are registered in one state, but for a short period you are going to some other state and you are going to make supply from there. For example, you are going to participate in some exhibition and you are going to put a stall from where you are going to sell your goods. So in those cases, the person is called as casual taxable person for that state for that temporary period, and he has to compulsorily register irrespective of turnover. Next, wherever you are required to pay tax under RCM or those e-commerce operator for whom section 9.5 is applicable. Now, if you recall, section 9.5 covers some notified services. When these services are supplied through online portals, then the online portal, which is over here called as the e-commerce operator, is the person liable to pay tax. Now, where this online portal, that is the e-commerce, is liable to pay tax, obviously the e-commerce operator, that is the online portal, has to get registered. But 9.5 presently covers only some notified services, so it has a limited application. Second, similar to casual taxable person, you have non-resident taxable person. Same like casual, the difference is this non-resident taxable person is a person who is residing outside India, who is a non-resident of India, and who is coming temporarily to India for the same purpose, for let us say participating in an exhibition from where this person is going to make an outward supply. Then the person who are either required to deduct TDS or who are required to collect TCS. Obviously, without getting registered, they can neither deduct TDS nor they can collect TCS. Now again, under GST, unlike income tax, the TDS and TCS list is very small. TDS is to be done only by government and government department with respect to certain supplies where the government is the contractee and going to make payment. And TCS under GST will be collected again only in one single scenario, that is where my supplies are through e-commerce operator. So the e-commerce operator has to collect the tax. Other than these two scenarios, no other scenarios under GST are covered under TDS, TCS. Next, a person who supplies on behalf of some other taxable person, so like an agent, if your principal is registered and you are supplying on behalf of principal, obviously you'll have to be registered. Next, suppliers other than notified under 9.5 who supply through an e-commerce operator. Now here, the e-commerce operator was required to get registered. Here, the suppliers who are supplying through e-commerce operator where the e-commerce operator is not covered under 9.5. It means the supplier himself has to pay tax. So the supplier has to get registered. Next, every person who is supplying order services from a place outside India to a person in India, that is all the foreign companies who are engaged in the order services and their recipients are in India, then they have to compulsorily get registered. ISD has to compulsorily get registered. Person who is supplying online money gaming again from outside India to a person in India, and some other classes of person which may be notified by the government. Now, this is the list which is given in section 23, whereby some relaxations are given, whereunder you need not be compulsorily registered. So first, a person who is engaged solely in supplying goods services which are either not liable to tax, like liquor or petroleum products, or which are wholly exempt from tax. So if you are engaged in any of these supplies and it is exclusive, means other than this you have no other supply which is covered under GST, then you are given a shield, you are given a protection whereby you are not required to get registered. Next, an agriculturist, but agriculturist will be given this protection of not taking registration, provided again his supply is limited to supply of the produce which is resulting from cultivation of land. So if the agriculturist is also involved in other types of transactions, then this particular protection will not be available and he may have to get registered considering the threshold. Then the next category is I am the person who is the supplier in a transaction which is under RCL. So I am a supplier, let us say I am a legal firm where my outward supply of legal services is covered under RCM. And I have no other supply, no other outward supply except this legal service. So I am given this protection whereby I need not take registration because anyways I will never be called upon to pay tax because my taxes wherever applicable will be paid by my recipient. So I as a supplier need not get registered. Now, this particular point has an exception. The exception is if I am the supplier of a metal scrap. So if I'm a metal scrap dealer, then even though it may be under RCM, I will still require to be registered. Then where I'm making interstate supply of services, here I'm getting that 20 lakh limit. So I need not register until unless my turnover crosses 20 lakhs. Then person making interstate supply of notified handicrafts. Again, they are not required to register up to 20 lakhs. Casual taxable person again making interstate supply of those handicraft goods. Again, they enjoy the 20 lakh threshold. Then person making supply of services through e-commerce operator. Again, they get the protection up to 20 lakhs. In other words, if you read both these points, what comes out is only if you are a supplier of goods, if you are making interstate supply other than handicrafts, or if you are making your supply of goods through e-commerce operator, only then you are required to take registration compulsorily and threshold will not apply. Otherwise, if the same thing is done by a service provider, threshold applies. Person making interstate supply of goods through an ECO with aggregate turnover not exceeding threshold and not making supply in more than one state with one enrollment number. So these are the cases where registration will be compulsorily applicable. Now the question comes where and within what time registration has to be applied. So question is where registration is to be applied. The answer is registration is to be applied in every state from where you are going to make a supply or wherever you have your place of business. So registration has to be taken in all those states. Now, in what time you have to take registration? So except for casual taxable person and NRTP, others are given 30 days window. A casual taxable person NRTP has to take registration prior. So even before the exhibition starts where they are going to sell their goods or services, they have to take registration in advance at least 5 days prior to the commencement of the business. But otherwise, others are given the 30 days window and within the date from which they become liable to register, maybe under 22, 24, whatever section applies to them, from that day, that is the day when their liability to register trigger, within 30 days, they can make an application for registration. Now, besides this, even where you are not covered in 22 or 24, still by your choice, you can voluntarily decide to register. Here, there is obviously no question of 30 days window because there is no trigger date. Here, by choice, whenever you want, you can apply for registration. Now, besides the regular businessman, there is a special category of registration which is called as UIN, Unique Identification Number. This registration is done by some notified international agencies like agencies of United Nations Organization or agencies which are multinational financial institutions or any other organization. In such cases, they are not engaged in any type of commercial or business activity, but they are operating in India on behalf of some foreign body or some government or some international body, which is given a special protection under international treaties. Now, these bodies or these organizations open their offices in India for varied purposes. Now, they are not making any outward supply, but whatever inward supplies they are consuming, on that the supplier is charging them GST. Now, this GST will become their cost. In order that they do not suffer the burden of this GST, they are given this choice that they can take this registration called as UIN, and then whatever inward side they have paid GST, later on they can file a refund application and get that amount refunded. That is why they take this UIN registration. Now, once you have applied for registration, what is the effective date of registration? Now here, there are two categories. First, the person who was compulsorily required to get registered, and second, the person who is taking registration voluntarily. Voluntarily person, the person's effective date of registration is the date when the person receives the registration number. But the person who was compulsorily required to get registered, that is who crossed the 22 threshold or who is covered in any of the specified transactions of section 24, for them, if you remember, we just studied that they have a 30-day window. Now, if they have made application within that 30-day window, then whatever time it takes to get the registration, their effective date of registration is the first day. First day means the date on which they became compulsorily liable to register. So let us say that date is today. Today is 30th of October. If 30 days from today, that is by 30th of November, if you make application, so you are satisfying the requirement of making application in 30 days. In such cases, whenever the registration is allotted, because the registration allotment has a procedure which may take time, still your effective date will be 30th October only. But if you fail to apply within 30 days, if you are late and you apply after 30 days, then the registration effective date will not be today. It will be the date on which you are actually given the registration number. So let us say your registration number comes on 15th of December. In first scenario, where you had applied within 30 days, your effective date is 30th October only, though you get the number on 15th of December. In second case, since you applied after 30 days, your effective date of registration is 15 December. That is when you get the number. Deemed registration. Now, what is deemed registration? The grant of registration, that is GSTIN or UN, under SGST, UTGST is deemed to be the grant under CGST also. It means we studied this above also. You need not take act-wise registration. So once you are granted registration under one act, it means you are granted registration under all acts. Second, rejection of application of registration under SGST is deemed to be rejection under CGST. So same, if grant is under one act is equal to other act, so rejection under one act is equal to other acts. Now, what is the procedure for registration? The moment you are liable to register, that is you trigger the registration condition, or let us you want to apply voluntarily. So you have to go to the portal. There is a form called as REG01. In that form, you have two parts, part A, part B. Part A is for getting, you can say, connected to the portal. So in part A, you fill in your basic details, whereby you create a temporary login ID, and the verification of email, verification of phone number is done in the first part, that is part A. Then PAN validation is done. So once you give these common details, you fill in your PAN number, and the portal, the GST portal connects to the CBDT portal to check whether whatever you have given as your PAN number linked with the specific mobile and email address. So that linking is done by sending OTP, and a temporary reference number is generated. This reference number will be used by you in all your future communications until you are fully registered. Now, using this temporary registration, temporary reference number, now you go on to actually apply for the registration by going to part B. In part B, you have to fill in all details of your business and all details of your legal person status. So if you're a company, you upload the company registration, MOA, AOA. If you're a partnership, you upload the partnership deed and so on. So you have to give details of your status, the legal status, and you have to also give details of your business. If you are having more than one places of business, you have to put one address as the principal place and other addresses as the additional place. Thereafter, you have to give details of all the bank accounts and details of who will be acting as authorized signatory. and you have to also undergo the Aadhaar authentication. Now, all these steps are to be done by the uh, taxpayer, and after filling and uploading all these details, now the form goes to the department side. The respective officer who is assigned the role of registration will be going through your form to check and decide upon whether it is valid and complete. But before that, one more thing. On receipt of an application, an acknowledgement is in the prescribed form shall be issued electronically. A casual taxable person, if you remember, he has to apply in advance, who is applying for registration gets a TRN, and this TRN has to be used by him to also make advance payment of tax. So not only he has to get registered prior, but also he has to make advance payment of tax. Now the question is, somebody will ask, sir, if he has not done the business, how he can make advance payment of tax? The answer is simple. The person will be estimating that what would be the liability, and on the basis of this estimate, the person would be paying the tax in advance. Just a minute. Yeah. So in case of CTP, they have to also make an advance payment on estimated basis. And once the exhibition is complete and now they are going back, they have to file the returns, and in that return, whatever is the difference between the advance payment and the actual tax liability will be either refunded if it were the advance tax was more, or if it is short, then he has to pay the difference with interest. In case of CTP, the registration and all will be allowed only after this particular advance tax has been deposited. Next, after this application is made, it is forwarded to the proper officer, and the part 2 of the registration process starts. Now in part 2, the officer will be checking your entire application along with the documents that you have submitted to check for the validity and authenticity and whether to allow or not allow you the registration. Now in this, there are different things that you have to understand and keep in mind. So first is, the proper officer examines the application and the accompanying documents. What he will check? If the same are in order. Answer is yes. Then registration is granted within 7 working days from the date of submission of the application without site verification if applicant successfully validated his Aadhaar authentication. So if you have done Aadhaar authentication, then within 7 working days and without making a site visit, your registration will be granted. Second, if your documents are found in order, registration will be granted within 30 days of application after verification of site and prescribed documents. Now, this will be done where the applicant fails to undergo Aadhaar authentication or does not opt for Aadhaar authentication. Second, where the proper officer deems it fit to carry out the site verification. Third, where a person who has undergone Aadhaar authentication is identified on common portal based on data analysis and risk parameters that it is necessary to carry out site verification. So in these 3 scenarios, site verification will be done and then registration will happen within 30 days. Otherwise, it will happen within 7 days, provided everything is found in order. But what if the proper officer finds that something is not proper, some document is not correct, or some document is incomplete? In this case, the proper officer will issue notice. Doing what? Seeking clarification or information or documents. This will be done within 30 days from application submission date or within 7 working days from application submission date. Now, when 30 and when 7? So 30 days, the officer will be doing when where a person fails to undergo Aadhaar authentication or does not opt for Aadhaar authentication, or the proper officer deems it fit to carry out site verification, or where the person who has undergone Aadhaar authentication but the risk parameter suggests that site verification should be carried out. So in short, here same 30 days were given to allow registration in all these three cases. Same three cases, 30 days is given, whereby the officer will issue the notice. Otherwise, he has to issue it within 7 days. Next, if the applicant has furnished the clarification information documents within 7 working days, then the time for receipt of notice is yes. If proper officer is satisfied with it, then proper officer will grant registration within 7 working days. So you have to reply within 7 days. And if proper officer is satisfied, he will also grant within 7 days. No, if the proper officer is not satisfied, or if you have not given the reply in 7 days, then the proper officer in this case will reject the application and will record the reasons in writing so that you can take your further actions on that. Okay. Now, what is the special procedure for CTP NRTP? Now, as we discussed, a CTP is one who has a registered business in one state but wants to make a supply from some other state but for a temporary period because he's not going to have a fixed place of business there. Then the other state in which this person wants to take this temporary registration, that is the casual taxable person. Similar lines, who is NRTP? It is a taxable person who is a foreigner who occasionally wants to effect taxable supplies from any state in India, and for that period the person is needing a registration. Now, what is common for both? The GST law prescribes special procedure for registration as also for extension of the operation period of such CTP and RTP. They have to apply for registration minimum 5 days in advance before making the supply. Further, registration is granted to them or period of operation is extended only after they make advance deposit of the estimated tax liability. Now, what is this period of operation is extended? So when you apply, at that time you have to also inform as to for what period this registration you are seeking. Now, which cannot be more than 90 days. So let us say I say that I'm seeking for 2 weeks. Now, for some reason, if I want to extend this beyond 2 weeks, I have to rerun the same process. I have to inform in advance. I have to also pay advance tax liability for this extended period. Next, registration is granted to them for a period specified in the application. So if I've asked for 15 days, they will give me for 15 days or maximum 90 days. Now, the second part is amendment to registration. Now, once you have got registered, there may be certain changes in your business which needs to be intimated to the department. How? By way of applying for amendment. Now, for registration, you had a 30-day window, but for amendment, the window is only of 15 days. Now, what is the point? Except for changes in the core field information, for all other things, you make the application and that will be done automatically on the portal. That is, it will not go to the officer for any check or approval. But if you are making change in the core field, then your application for amendment will be going to the proper officer, and the proper officer will then check and will decide to approve or disapprove again in next 15 days. For change in non-core field, no approval of proper officer is required. Then comes the last part, which is cancellation or suspension. Now, when we talk about cancellation, cancellations are of two types. One, where the taxpayer himself, herself, itself applies for this cancellation. Why? Because the taxpayer is no more going to make any taxable outward supplies, or the turnover will be falling below the limit and the taxpayer will not be engaged in any specific transactions mentioned in 24. So in both these cases, the taxpayer would like to deregister. That is where the taxpayer will apply for cancellation. Second is where the cancellation is done suo motu by the department. Now, when this cancellation is done suo motu by the department, one, where the department feels that, okay, that person is, let us say, person has expired or the business is discontinued, so registration is not required. Or two, the taxpayer is engaged in some fraudulent activities. In any of these cases, the department may proceed for suo motu cancellation. Now, what are the points? Registration can be cancelled either by the officer or on an application by the registered person. Now, when both cases it will be done, or let us say where you can apply and it will be cancelled, where it is not your fault and it is in normal course, there is no fraudulent activity. So when this will happen, you are discontinuing the business, or the business is being transferred, or it is amalgamated or demerged with some other entity, or there is change in constitution, or you do not require the registration any longer. Why? Because there is no business or the business is below the limit. Next, registration can be cancelled by the proper officer suo motu. This is where there is some problem at your end. So the registered person has contravened any of the provisions of the act, or the person has failed to file the returns for continuous 6 months period, or 2 tax periods wherever you are a quarterly return filer. Voluntarily registered person has not commenced the business up to 6 months. So after taking voluntary registration, you have not done any business for 6 months, then also the officer can cancel. And registration was obtained by means of fraud. So whatever documents you had submitted or whatever details you had given, later on it was found that it was all bogus. In all these cases, the officer can suo motu proceed for cancellation. So once a registered person has applied for cancellation or the proper officer seeks to cancel, the proper officer may suspend the registration during pendency of proceedings. So instead of directly cancelling until the entire procedure of cancellation is run through, temporarily the officer may suspend. Now, what is the procedure for cancellation? First, where the registered person has applied for cancellation, the registered person seeking cancellation shall apply for the same within 30 days of the occurrence of the event warranting cancellation. Now, what is this event? Closure of business, or in case of death of the assessee by the legal heirs, or let us say your business falling below the threshold limit. In any of these cases, you are expected to make application within 30 days. The proper officer shall issue the order of cancellation within further 30 days of submission of application. Now, when you are making the application for cancellation, in that particular case, you have to also furnish the details of whatever stocks you are holding. Now, why this is to be done? Because whatever stocks you are holding, and if you have taken GST credit on that, now you need to reverse or pay off. So in order that that is calculated, you have to give the details of your stock also. Next, where the proper officer cancels the registration, what is the procedure? The proper officer will issue a show cause to the registered person, who has to reply to the said notice. Now, after sending this show cause, if you have given the reply which is satisfactory, then the proceedings initiated by the officer will be dropped, or where instead of replying, the person furnishes the pending returns or make full payment, which was the reason for cancelling, still the proceedings will be dropped. Second, cancellation order shall be issued within 30 days of reply of show cause where the registration is liable to be cancelled. Now, where your registration was cancelled by the officer suo motu for any of the reasons where the officer felt you are at mistake, and at that time you could not respond for some reason, but in future period, when you got to know that your registration is cancelled and it is cancelled where you feel it should not have been cancelled, you as a taxpayer are given the opportunity to visit the department and explore the possibility of reinstating your registration. How? By cancelling the cancellation. So the registration cancellation procedure can be revoked. How it can be revoked? In case where the registration is cancelled suo motu by the officer, the taxable person can apply within 90 days, which is extendable by 180 days by the commissioner or officer authorized, and that officer cannot be below the rank of ACJC, of the date of order cancellation, requesting the officer to reinstate your registration or revoke the cancellation. However, before so applying, the person has to make good the defaults. What are the defaults? Maybe if return was not filed, payment was not done, so all these things have to be done. If satisfied, the proper officer will revoke the cancellation ordered by him. However, if the officer concludes to reject the request for revocation, he will first observe the principle of natural justice. How? By issuing a notice to the person and giving him the hearing. However, there shall be deemed revocation of cancellation upon furnishing of pending returns, subject to the condition that the registration has not been cancelled by the proper officer under Rule 20. So where the registration was simply cancelled only because for one reason, that you did not file return, moment you file the return, the registration will be reinstated. So these are the provisions relating to the topic of registration. Now we'll go to the second topic for the day, that is relating to tax invoice, debit notes, credit notes. Just a minute. Just give me a minute, students. Yeah, sorry, today I'm alone at home, so continuously somebody is coming. I have to attend them. Yeah, sorry. So we go to the next topic. Yeah. Now the topic is on the records, or we should say the documents that you are supposed to maintain, the document that you are supposed to issue. Majorly, they are invoices, debit notes, credit notes, delivery challans. Now, these are some prescribed documents which you, as a registered person, are required to issue. Now, an interesting point that you should know is under the GST law, majorly all documents except few, very few, are issued by the supplier only. Like how normally in case of our accounts or a regular business, if let us say the seller is giving debit note, the buyer gives credit note. But this type of thing is not allowed in GST. Not allowed means for accounting purposes you can do, but what has to be uploaded on the portal, that is only one-sided, that is only by supplier. There are specific documents only which will be issued by the recipient. Now, what are the various documents and who has to raise, what are the timelines? Let us understand. So, who can raise a tax invoice? Obviously, a registered person only. A non-registered person cannot raise a tax invoice. Further, within registered person also, only the person who is supplying taxable goods or services. If you are supplying exempt goods or if you are a composition dealer, in both these cases, you do not issue tax invoice. You issue, pay attention, bill of supply. So where you are a registered person and you are either supplying exempted goods or service or you are a composition registered dealer, in both these cases you do not issue tax invoice, you issue bill of supply. Now, what is the time limit given for issuing the invoice? First, if you are a supplier of goods and it involves movement, that is the goods have to be delivered, then the time limit is immediately at the time of removal. Obviously you can do it before, but there is no cushion of 30 days, 45 days as you find in case of services. So in case of supply of goods, you have to give invoice immediately on date of removal. Second, where goods are given on as is where is basis, that is where no movement is involved. In such case, whenever the goods are handed over or the delivery or the possession of the goods is handed over, at that time immediately you have to give the invoice. So we can simply say that when invoice has to be given, let us understand it in a different way from the perspective of Sale of Goods Act. If I can explain, because supply of goods is majorly sale of goods only. Wherever the property in goods is transferred, that is where in the language of Sale of Goods Act, a sale happens. At that time, you are supposed to give invoice under GST also, because sale is equivalent to supply. Next, where the goods are sent on sale or return basis. Now here, since you are sending it on sale or return basis, so on the day when the goods are delivered by you, at that day there is no concluded supply, because if the goods are liable to be returned, and the power is with the recipient to decide or to accept or not to accept. In this case, the day when you send the goods or the goods leave your premises, there is no concluded sale. That is where the law says that you will be issuing or required to issue the tax invoice when you receive the confirmation from the recipient. So whenever the recipient confirms that yes, I accept your goods are as per the quality, etc. At that time, the supply is concluded. So at that time, you are supposed to issue the tax invoice. Or in other words, the law has given you 6 months period until which you can wait and you can issue the invoice in cases of where the goods are sent on approval basis. If before 6 months you get the confirmation, that is the supply is concluded, that day you issue invoice. If not, then on the day when the 6 months is over, you have to issue the invoice. Next, in case of supply of services, you are given a window of 30 days. That from the day of provision of service, you are given 30 days to issue the tax invoice. In case of insurers and banking companies, their time limit is 45 days from the date of provision of their service. Next is in case of continuous supply of goods. Now, firstly, what is continuous supply of goods? Continuous supply of goods is a typical type of transaction where there is an agreement between the seller and the buyer, whereby the seller will keep on delivering, dispatching the goods on a recurring basis or on a particular frequency. And the most important thing is that on every delivery, there will be no accounting or hisab done as to how much is the total payable amount. Means what? We have agreed that I will keep on sending the goods periodically or on recurring basis, and the contract or the agreement between us is such that we have also fixed up a date when we will settle our accounts to find out how much is payable or receivable. So this is what is the concept of continuous supply of goods. Now, in case of continuous supply of goods, when the invoice is to be issued, it has to be issued on or before the time whenever you are going to settle your accounts. So whenever, let us say we have decided that every 15 days we will settle the account, or every 2 months we will settle the account. So the date when we decide to settle the accounts, that is the date when the invoice has to be issued, or whenever if there are successive payments made. So if let us say similar to how I have to keep on supplying the goods, if there is a condition that the buyer also has to periodically make some payments. So whenever the buyer makes the payment, at that time also the invoice has to be issued. So it is whichever is earlier. Next, in case of continuous supply of services, now there are three types of continuous supply of services or three types of contracts. Again, in case of continuous supply of service, there is an understanding between the supplier and the recipient that the supplier will be on ongoing basis supply the services to the recipient. In such cases, the contract or agreement will be having some due date provided for making payment. So if there is a due date which is provided in the contract or agreement for making the payment, then the invoice has to be issued on or before the due date. Whether you make the payment or not, that is a different thing. But if a due date is provided, the bill or invoice has to be raised on or before the due date. But if there is no due date provided, so the contract is completely silent about payment, then it will be at the time when payment is made by the recipient. Third is where the contract is such that they have linked the payment with completion of an event. Like generally in case of construction, they say that okay, on completion of plinth you pay 10%, on first slab you pay 15%, on second slab you pay 15%, and so on. Then in that particular case, invoice has to be issued every time when that particular event is completed, which is the triggering point for payment. So if you observe, in case of continuous supply of service, everything is linked to the payment. That is, the issuance of invoice is linked to payment. What is important over here is, unlike the regular supply or regular services supply, where 30 days or 45 days window was given, there is no such window given in case of continuous supply of service. So this has to be noted. So you cannot assume that in case of all service supplies, you will be having 30 days window. That is not the case. The 30 days window is given only in specific cases, or I will say it is given only in case of regular supply of services, not for these special supplies, which is called as continuous supply of service. Now, the second part is, what are the important contents of this invoice? So these are some of the prescribed contents as per the rules. These have to be compulsorily present in the invoice unless the law has given you relaxation. Now, what are these important contents? Obviously, the first thing is name, address, GSTN of the supplier, serial number and the date of invoice, then the name, address of the recipient, and if the recipient is registered, even the GST number. Then the next is name and address of the recipient along with the delivery address, name and state code if the recipient is unregistered. So for unregistered recipient, you have to also provide the state code. That is only because to ensure which state should get the revenue and also to decide many times the place of supply. HSN, description of the good service, quantity, total value of the supply, taxable value of the supply, rate of tax, amount of tax, place of supply. Where the delivery is different from the place of supply, then the proper and complete address of delivery. If the tax is to be paid under reverse charge, that also has to be mentioned on the face of invoice, that in case of this invoice, tax has to be paid under RC. Signature of the supplier or the authorized signatory, and this may not be required if the invoice is a e-invoice where it is being specifically excluded by the Information Technology Act. And QR code having the embedded IRN. This is applicable wherever e-invoicing is made compulsory. Now, how this invoice has to be issued? In case of goods, compulsorily 3 copies, and in case of service, compulsorily 2 copies. You may have additional copies for your accounting or other MIS purposes, but from the perspective of GST, these are the number of copies which are, you can say, the minimum number or the required number. Next, the serial number of invoices issued during a month quarter shall be furnished electronically in form GSTR1. Now, this is a different type of requirement. See, normally in GSTR1, that is your monthly return, you have to give the details which are there in your invoice. That is the HSN, value, place of supply, tax rate, etc. But this point says that besides all those details which is there in your invoice, you also have to give details about the invoice. What details? You have to mention that in this tax period, let us say in this month, I have issued invoice from number 1 to 51. In the second month's GSTR1, I'll say I have issued invoice from number 52 to 105. In the third, I will say 106 to 200. So this is what is this point saying. Next. Now, e-invoicing has been introduced under the GST law, and originally when it started with the 500 limit, 500 crore turnover applicability. Now it has been reduced to as low as 5 crore turnover. But the question is, firstly, what is e-invoice? So many times people confuse e-invoice to understand it wrongly, as if e-invoice is an invoice which has to be generated from the GST portal. Means they wrongly understand e-invoice as that you will give the details on the GST portal and the GST portal will make the invoice and give it to you. That is not e-invoice. where invoices, wherever e-invoice is applicable to you, in that case also, you only prepare the invoice in the fashion as what you are preparing. So it may be physical, it may be what you can say, computerized or whatever. So whatever is your mechanism of preparing the invoice, that invoice will be followed by you. No change in that. The only thing is that you have to report the details of your invoice on the e-invoice portal. There is a designated portal for e-invoice details, and when you put or post the details on the e-invoice portal, then you will be given a acknowledgement, which is IRN, which is a 64 character number, which will be a proof that yes, your invoice details have been registered on the GST portal. So invoice preparation is not through the portal. Invoice preparation is through your accounting mechanism only. But the invoice details have to be uploaded, and an acknowledgement that yes, portal has accepted your invoice details and the portal has registered your invoice details has to be taken. That is what is e-invoice procedure. Now, to whom this is applicable? First, obviously, you are a registered taxpayer. Most important, your turnover on India basis is more than 5 crores in any of the financial year from 17-18 till date. So it is not that it should be only of the previous financial year. Generally, for all other purposes like registration and all, we see the immediate previous financial year's turnover. But for deciding e-invoice applicability, the law says any financial year from the date of implementation of GST. Now, in this case, you are required to issue the e-invoice. Now, certain terms, there is something called as the e-invoice schema. Schema simply means a format. So what is an e-invoice schema? E-invoice schema means there is a standardized format given of e-invoice, which does not again means that your invoice should be in this format. It is the portal in that is what the portal requires the details. You have to fill in the details. So whenever you are filling the detail of invoice in the e-invoice portal, they have given it in a particular format of theirs. So you have to fill it in that format, but it is not necessary that your invoice should be prepared in that format. So it is only the format for the portal's reference and all its records. Now, there is a separate website for this e-invoice generation, which is called as Invoice Generation Portal or IRP. And on this portal, you will be uploading the details of your invoices, and the portal will register it. They will internally verify to check whether the same invoice is earlier reported or the same invoice number is used twice, etc. If not, if everything is found correct, the portal will register the details that you have uploaded. That will become one of the entries in the portal, and you will be given a unique reference number, which is called as IRN. This number is a 64 character number, and wherever e-invoice is applicable, if you remember in the above point of the details what are required to be printed on the invoice, you have to also print this IRN, which is also proof given to your buyer and everyone who sees your invoice that yes, this invoice has been uh, generated and the details have been registered on the portal. That is, e-invoicing has been done. GST invoice will be considered as valid only after doing the e-invoicing procedure if invoicing is applicable. Now, what are the benefits of doing e-invoice? Auto reporting of invoice in the GST returns. If you are doing e-invoice, then you need not fill in GSTR1, that will be auto filled. Similarly, on the basis of e-invoice, your e-way bills part A will be auto generated because e-way bill also has two parts, A and B. A is the invoice details, B is the transporter's details. So A will be auto filled from the basis of the e-invoice. Then subsequent reduction in the transcription errors. So if let us say today you are preparing invoice, in future sometime you are uploading it on portal, there is always a possible of some errors creeping in that will automatically be reduced at the first stage itself. Then early payment, cost reduction, improved efficiency of business, these are generic benefits. From the government perspective, reduction of tax evasion and elimination of fake invoice is there side benefit. Now, situations in which e-invoice is applicable or not applicable. First, supply of goods or service to a registered person by a notified person, that is the person whose turnover exceeds 5 crore, etc. Invoicing is applicable. Exports, e-invoice is applicable. But where the same notified person is making supply to an unregistered person, which is called as B2C supply, as on date, e-invoice is not required. So e-invoice is required only for B2B supplies as on date. For B2C, we have another concept called as QR code, but for that still the limit is very high. That is applicable only where the entity's turnover is exceeding 500 crores. So that is still a long journey before B2C comes under any such type of reporting. Next, wherever you are ISD and you are giving an ISD invoice for passing on the common credits, again, no invoicing is required for ISD's invoice. Next, supplies made by the notified person, tax on which is payable under RC. Very important. So let us say the supplier who is the notified person whose turnover has exceeded 5 crore and he is required to make e-invoice. His tax is payable by the recipient. He don't have to pay tax. Still, he will have to do e-invoicing. Opposite, where specified category of suppliers received supplies are received by notified persons from unregistered persons attracting reverse charge or through import of service. That is where the notified person is receiving inward supplies on which tax is payable under RCM. So where this happens, you have to generate a self-invoice. Now the question is on self-invoice, whether e-invoicing is applicable. Answer is no. And whether in case of import of goods where bill of entry is prepared, whether e-invoicing is applicable. Answer is no. So you can see invoicing is applicable only on your outward side for outward transactions, not for your inward transactions, even though you have to prepare the invoice on the inward transaction or pay tax under RCM. But e-invoicing is not applicable on the inward side transaction. It is only on the outward side transaction. That also, it will not apply wherever it is a B2C transaction or it is a transaction only for passing on the credit, that is by IST. Next, no requirement of issuing invoice copies in triplicate. So wherever e-invoice is applicable, there is no need of issuing invoice copies in triplicate, duplicate. See, your regular invoice has to be issued in duplicate, triplicate, but e-invoicing is just registering the invoice details with the government. So there is no duplicate, triplicate in that. Now, who are excluded from this e-invoicing requirement? So even though your turnover is exceeding 5 crores, you will not be required to generate e-invoice if you are SEZ, if you are an insurance or a banking or a financial institution, or if you are a GTA supplying services in relation to transport of goods by road, you are a supplier of passenger transport service, or you are a person supplying service by way of admission to exhibition, that is in simple words, you are a cinema theater, or you are a governmental department or local authority. So these are the people who are excluded from generating e-invoice. Other than these, all other whose turnover exceed 5 crores in any of the financial years have to compulsorily generate e-invoice. Now, what is the overall workflow whenever e-invoice is applicable? The supplier creates GST invoice as per their regular accounting or their ERP system. So as I said, for this, there is no compulsion in e-invoice that it has to be generated on the government portal. It is done by your own software, whatever you are following. Now, the details, you have to ensure that it covers all the details of e-invoice, which is generally there in any proper invoice. Now, you have to upload the details in the e-invoice schema on the invoice registration portal. After you upload it and you submit the details, the e-invoice portal do internal check, and within fraction of second after making the internal check in the records, if everything is found correct, it gives you IRN, which is the sort of acknowledgement that yes, your invoice has become e-invoice. Now, the IRP digitally signs the e-invoice and adds QR code. IRP returns the e-invoice to the supplier, and supplier shares the e-invoice with the receiver along with the QR code. So the portal on which you are doing all this process, once the portal has updated the GST records with your invoice details, the portal gives you the e-invoice in the form of that 64 character, which is the proof that yes, your invoice is registered. And it also gives you a unique QR code so that if that unique QR code is scanned, that will also reflect the details of the invoice. This QR code and the invoice IRN, you have to print it on your invoice whenever you are giving physical invoice. Generation of e-way bill, populating relevant parts of GST returns, etc. So this portal, now once all the procedure is done of registering your invoice details, will send the e-invoice data along with the IRN. Now it is giving it to you, plus it is given to the GST system. Now when it is given to the GST system, what the system does, it auto populates the details in your GSTR1, and through your GSTR1, it auto populates the details in GSTR2A of the receiver. So this is the first thing that this IRP, the invoice registration portal, does. So it updates your GSTN system, both yours in the seller selling side, that is sales side, and the buyer in the purchase side. Similarly, it goes to the e-way bill portal also, and it updates your invoice details in the part 1 of the e-way bill. So parameters, example, transport ID, vehicle ID, etc. reported in e-invoice schema facilitate generation of e-way bill. Cancellation. Now, if you want to cancel the e-invoice, it can be done by the seller within the specified time. After that, that is also not allowed. Amendment of reported invoice, amendment of e-invoice already reported on the IRP. Is it possible on the GST portal? Answer is yes, but it is not possible on the IRP portal. Now you'll say, sir, what it is? So you remember the above point. We discussed that once your invoice is registered on the portal, it updates your GSTR1. Now, if let us say you want to make some changes in that, you cannot change the IRN. You cannot change the details in the IRP, that is the invoice registration portal. So it means e-invoice portal details will be as it is. Maximum you can cancel it within 24 hours. Once that is gone, no cancellation is also allowed. But what can be done is, when this data auto populates in your GSTR1, which is on the GST portal, you can go there and edit on the GST portal. So that is what is the option available with you. Revised tax invoices to be issued in respect of taxable supplies affected during this period. Now, the point of uh, e-invoice is over. Let us proceed to the next point. Now, what is next point? The next point is about revised tax invoice. Now, what is revised tax invoice? Firstly, let me clear one thing. Again, there is a misunderstanding that this point of revised tax invoice allows any businessman that after they have issued one invoice and they find some mistakes in that invoice, they can change that invoice and make it a revised invoice. The answer is no. So let me first clear this point, that you are not allowed to change an invoice which is prepared. Maximum you can cancel the invoice, or if some amount in the invoice has to be inflated, deflated, you can use the debit note, credit note. But the same invoice cannot be changed. Then what is revised invoice? See, revised invoice deals with one particular specific scenario. What is that particular specific scenario? It is applicable to the scenario where you had applied for registration. Now we go back to the registration chapter, whereby when you apply for the registration and you have applied it within that 30-day window. So same example, you cross the threshold today of 22 section, or you involve in any of the transactions of 24 section, because of which today you become liable to get registered. Now from today, within 30 days, you have to make application, and you have made that application within this 30-day period. Now, if you have made that application within this 30-day period, now, if you remember what we studied in the registration chapter, that if you have made application within the 30-day period, your registration, even though given in future, let us say you get this registration number on 15th of December, from today after 45 days, still your registration is effective from today. That is from the date when you cross that threshold of taking a registration. Now, in this particular case, what is revised invoice? Revised invoice is applicable to only this one scenario. What is this scenario? Pay attention. Now, I am required to pay tax from tomorrow because today I have crossed the threshold. So from tomorrow, I will be required to pay tax. I have also made application within 30 days of registration, but the registration is granted on 15th of December, which is total 45 days from today. Now, in these 45 days, how will I do business? Because I have to pay tax, but I'm not having a registration number. So the law has made a concept that for these 45 days, until you get the registration number, you make supplies giving kacha invoice. Kacha invoice means invoice which is not a tax invoice. Obviously, you cannot give a tax invoice because you don't have a GST number. But when you are giving these invoice, you will inform your recipient that, see, I am now covered under GST. So on this invoice, I will also be charging GST and collecting GST from you. But that is all only after I receive the GST number. So you will be informing this to all your buyers, and then you will be issuing them the tax invoice after 15th of December. In my example, when you get the registration, and after 15th of December, what you will do is whatever invoices you have given between these 45 days, that is from 31st of October until 15th of December, till the date you receive the registration number, all these invoices you will change with a tax invoice. That tax invoice which you are giving for this 45 days period in which you had given the kacha invoice, that invoice is called as revised tax invoice. So revised tax invoice is not applicable in any regular scenario that I have given you one invoice, I want to correct it, so I correct that invoice. No, that is not revised tax invoice. No such correction is allowed. What is allowed is that you can give a revised tax invoice only in this one scenario where the registration has taken 45 days. So your registration is effective from an earlier date, but for that period of 45 days, you had given kacha invoice, which you replace with a proper invoice, proper tax invoice. That is what is revised tax invoice. The next concept is consolidated revised tax invoice. Now, before I explain you consolidated revised, let us first understand what is the normal consolidated tax invoice. Now, there is a relaxation under the GST law from issuance of invoice. Now, first rule is where if you are registered, you should issue invoice in all cases. However, there is a small relaxation. The relaxation is if you are making the sale or supply to an unregistered person. So your buyer is an unregistered person. So it is generally applicable to all retail shops of, let us say, medicine, of, let us say, grocery, or any small retail shop where the buyer who are coming are consumers like you and me, and the value of that one single supply to that one buyer is below 200 rupees, and the buyer is also not demanding invoice. Like, let us say you go to a medicine shop, you buy some medicine worth 100 200 rupees, you don't ask for any invoice. In such cases, the supplier is given a relaxation of not giving separate invoice to each of these buyers. Instead, what the supplier can do at the end of the day, for all these transactions which happen throughout the day of small amounts where he did not give the invoice, he can make one single invoice for all these transactions. This single invoice is called as consolidated tax invoice. So basically, the concept of consolidated tax invoice is regarding those small supplies which you made throughout the day to unregistered persons who did not demand an invoice, so you did not prepare a separate invoice for them. For all such small transactions, at the end of the day, you can collectively prepare one single invoice, which will be called as the consolidated tax invoice. Now, once you have understood consolidated tax invoice, now on these lines, you will understand what is consolidated revised tax invoice. Now, firstly, what was revised tax invoice? The invoice that you prepare for this 45 days period between the date when you became liable for register till the date you actually got the registration. So for these 45 days, whatever supplies were made, Now those supplies you are converting into pakka supplies by giving a proper tax invoice, which is called as a revised tax invoice. Now again, in this 45 days period, there would be small supplies where the buyer is not demanding an invoice from you, but you have to give a pakka invoice, you have to prepare a pakka invoice. So again, what you can do is you can prepare one single consolidated revised tax invoice for all the small transactions happening in this 45 days period, where the buyer is an unregistered person, the buyer is not taking any invoice from you, so you can prepare one consolidated revised tax invoice. Further, in case of interstate supplies where the value of supply does not exceed 2.5 lakhs, a consolidated revised tax invoice may be issued separately in respect of all registered recipients located in a state. Fine. So that is one exception to that. Now we come to bill of supply. This I had explained at the start also. What is a bill of supply? So wherever you are a registered person and making supply of exempted goods or service, or you are registered as a composition dealer. In both these cases, you have to issue invoice because you have to pay tax, but your invoice will not be tax invoice. In fact, you don't have to pay tax if your sale is an exempted sale, but you have to pay tax if you're a composition dealer. In this case, both these cases, since you don't have to charge any tax on your invoice, the invoice that you will issue will not be a tax invoice, it will be a bill of supply. So bill of supply is parallel to tax invoice. The details in the bill of supply are similar to tax invoice except for the tax rate and tax amount. Next, receipt voucher. Now what is this receipt voucher? Whenever you have taken an advance, to report this advance in your GST records and in your GST returns, you require a document. Now, since till date a supply has not happened, you are not obligated to issue an invoice. It may be tax invoice or it may be bill of supply. You are not obligated. Why? Because the supply has not happened. You have only received money in advance. In such cases, to report this advance payment received, you will be giving to the recipient a receipt voucher. That is what is a receipt voucher. Now, when you are giving receipt voucher, there could be a challenge. What is the challenge? At the time of receiving this advance, you are not sure what will be the rate of tax. Why? Because you have to supply multiple items. The recipient has come and given you a lump sum round figure advance and not said that this advance is for this particular item or this particular item. In such a case where the advance is not linked to any particular item and you are going to supply multiple items for which there will be different tax rates, in such cases, you do not know what will be the actual tax rate of any of these items today, because today you have only received money, but the goods are yet to be supplied or the services are yet to be supplied. In such cases, the law says that for the time being, you pay tax on this advance at the rate of 18%. Now, I hope you all know that there is no tax payment required on advance received against goods. So by default, what we are studying, 18% is applicable only when you are receiving advance payment against services. Second, similar to the problem of rate of tax, if the other problem is you do not know what will be the nature of the supply, whether IGST, that is interstate supply, or C plus S, that is intrastate supply. When the nature of supply is also not known because the person has not yet informed you where he wants delivery or what will be the place of supply, then again, they are saying that you report this transaction as an interstate supply transaction. So these are the two carve-outs given in the law, specifically with relation to a receipt voucher. Now, whenever there is a receipt voucher, there is a possibility of refund voucher. So refund voucher is linked to receipt voucher. Hence, this part is repeated that the buyer paid me advance. I gave to the buyer the receipt voucher. But later on, for some reason, I could not make the supply and our contract is terminated. Now, if my contract is terminated without making a supply, I have to return back the advance. Now, when I'm returning back the advance, in that particular scenario, on return of advance, I will have to again prepare a document to record and report this return of advance. Because to that extent, I will again adjust my tax payment also, because if I have made payment of tax on advance, now I should get back the amount. So how I'll do that? I will prepare a refund voucher. So since there is no supply, I will return back the advance, and for returning back the advance, the document to address this particular transaction, to report this transaction, is the refund voucher. Then comes another concept of self invoice. Even though only the word invoice is written, you will read it as self invoice and payment voucher. Now, both these things are applicable whenever the transaction is under RCM, where the recipient of those goods services is a registered person, and the supplier may be a registered or an unregistered person. Now, in both these cases, what happens? Now, wherever the supplier is a registered person, the supplier will give me an invoice. I don't have to make a self invoice. But if my supplier is unregistered, in that case, the supplier will not issue me any invoice. But I need to have an invoice because this transaction is attracting tax under RCM, and this has to be reported through an invoice. Only then I can get ITC. So what I will do is, the law requires me to issue an invoice on myself. So my supplier is not giving me an invoice. So I will be creating an invoice on myself for this RCM transaction. That invoice which I am creating on myself is called a self invoice, where I am creating invoice on myself to report that RCM transaction. That is what is the first point. What is a payment voucher? In case of all RCM transactions, since now tax is to be paid by the recipient, and I have to pay tax on earliest of the dates, one when I receive the good service, or when I make the payment, or 36, 31 days or 61 days. Now, since here, one of the trigger points for making payment of RCM tax is also making payment. If I have made payment in advance, what is the proof that I have made payment in advance? So that is what is reported using a payment voucher. So self invoice is where the recipient is registered, the transaction is under RCM, maybe 9394, and the supplier is unregistered. In this case, the recipient shall issue a self invoice, that is invoice on its own self, which is what we call as self invoice. Now we come to the next part, which is on credit note, which is covered in section 34. Now, when credit note is applicable, when one or more tax invoices has been issued, and after the issue of tax invoice, it is identified that the taxable value reported invoice is higher by mistake, or the tax charge in the invoice is higher by mistake, or where the goods supplied are returned, or where the goods supplied are found to be deficient. In all these cases, the invoice has reported a higher tax. We need to reduce that tax, and wherever required, even reduce the value. Now, how to reduce? We already discussed about you cannot change the invoice now. So what you will do is, the supplier, only the supplier, as I said earlier, documents are majorly issued by the supplier, not by the recipient. Recipient will be issuing very few documents, and they are the above two documents. What? Self invoice and payment voucher. These are the only two documents which are issued by the recipient. Other than that, all documents are only issued by the supplier. So the supplier will issue one or more credit notes, and in the credit note, the supplier will be reporting the reduction in value or the reduction in tax. And this credit note will be reported on the GST portal. It will also reflect in the 2A, 2B of the recipient. So the recipient also has to reduce the ITC. Next is debit note. Now, when we talk about debit note, it is applicable in exact reverse scenario where the taxable value reported in the invoice is lesser, or the tax charge in the invoice is lesser. Again, when these two mistakes have happened in the invoice, instead of changing the invoice, what we will do is, the supplier will issue one or more debit notes by reporting the differential value or the differential tax and send it to the recipient. Again, the supplier will upload this in the GSTR1. It will appear in the 2A, 2B, and the recipient can take the input tax rate of this extra tax charged. So these are the pointers relating to tax invoice or debit note, credit note, right? Now we will take a 15 minutes break, and after break, we will resume with the other topics for our today's discussion. Now, our next topic in the revision is the topic on maintenance of accounts and records, and also the topic of e-way bill. Now, the first question about maintenance of accounts is who is required to maintain books of accounts and at what place? So, first is every registered person will be required to maintain books, and these books have to be maintained at their principal place of business plus at the additional place of business. So, in short, the books have to be maintained at their respective places to which that particular transaction pertains. Next, how or in what format the account has to be maintained. There is no such format prescribed, but the law provides for the details that should be covered in your accounts and records. So there is no format given, but the content or the details that should be accounted for is given. What it says: a true and correct account of the following is to be maintained. One, so these details should be covered in your records and accounts. One, details of the production or manufacturing, then the inward and outward supply. So both side details has to be covered. Then your account should also provide details of the stock that you are holding at any given point of time, the ITC availed, the output tax which is payable and which is paid. Further, records which are prescribed by the rules are: there should be records of reverse charge supplies along with relevant documents, of goods services which are imported, exported. Further, separate accounts of advances and addresses of the premises where goods are stored. Besides this, you should have details relating to names and addresses of suppliers of goods or services chargeable to tax and even your recipients. So these are the details which are supposed to be maintained in your records, and these records have to be maintained at every place of business. Now, records which are to be maintained only by a supplier except a composition dealer. Accounts of stock of goods received and supplied, including the opening balance, receipt, supply, goods which are lost, stolen, destroyed, written off, etc. So you can understand the purpose of this is because since you are availing ITC, we need to check the thorough details of whatever stock of goods have been received, what is utilized, and what is in balance. Similarly, account of the details of tax which is payable, firstly which is collected, then which is payable, and then which is paid. Now, for paying this, you would have claimed the ITC. So the details of ITC which is claimed by you, and this all has to be done along with mapping it with the tax invoice, debit note, credit note, delivery challan, etc., which you have issued during the period. Next, what are the records that the agent should be maintaining? So the agent should maintain authorization received from each principal to receive or supply goods. So firstly, you can say something like the regular contracts, or if there is any authorization note which the principal gives to the agent needs to maintain that. Second, particulars of goods or services which are received or supplied by the agent on behalf of its principal. Details of the accounts which the agent has furnished to every principal. Now see, agent also has to give some details to the principals of what? Of the transactions which the agent has done on behalf of principal. For example, agent has supplied goods, service, or agent has received money, etc. So those details should be maintained. Tax paid on the receipts or supply of goods or services effected on behalf of the principal. So whatever transactions the agent has done for the principal on behalf of the principal, and what is the tax which the agent has discharged. Next, records to be additionally maintained by a manufacturer and a service provider. What are they? A manufacturer has to maintain records which deals with monthly production, showing the quantitative details. This is very interesting. So in all other records, you are supposed to give the values. Here, for a manufacturer, he has to give quantitative details of what? Raw materials or input services which the manufacturer has used in the manufacturing. Then goods which are manufactured out of this, including waste or byproducts, if any, which are manufactured. Why this is done? So that the department can tomorrow come and check the input output ratio and ensure that there is no under-reporting of any transaction, or many times what people do, they under-report the sales. So actually they would have produced that, but to under-report the sales, they will obviously under-report the production. But when you are giving the details of raw material, the stock and the consumption, so from that, this can be linked. That is why these details are required. Similarly, a service provider has to give details of, again, quantitative details of goods used for providing their service and details of input services used in providing their service. Next, what are the specific type of records to be maintained by works contractor who are executing the works contract? A works contractor has to provide details of names and addresses of person on whose behalf the works contract is executed, and the persons from whom, that is the suppliers from whom he has purchased goods or services which he will be consuming in this works contract. Next, separate record to be maintained by the person executing works contract relating to what details of payment received against the works contract executed, and the description, value, quantity of goods services received or utilized in performing the works contract. Next, records to be maintained by the operator of the godown warehouse or by the transporters. So records to be maintained by owner or operator of godown or of warehouse will be first, whether they are registered or not. Second, the records relating to the consignor consignee, this is applicable for transporter, and other relevant of goods in such manner as may be prescribed. Now the transporter will provide details of what? Records of goods transported, goods stored in transit, GSTN of the registered consignor consignee, and for each of his branches, he has to maintain these details. Next, a warehouse keeper will have to maintain details or record details of the period for which particular goods are in the warehouse, including the particulars relating to the dispatch, the incoming movement, outgoing movement of these goods. Now, how these records have to be maintained? What does the law says? Records can be maintained in electronic form also. So it is not compulsory that it should be only in physical form. It can be in electronic form, and it should be authenticated by digital signature. Such records need to be produced on demand in hard copy or even in electronic format. Proper electronic backup of records has to be maintained. Records which are in electronic form, that is the books of accounts, include any electronic form of data stored on any electronic device. So where it has to be maintained on electronic, in the electronic form, it can be stored in any of the devices. The details of the files, their passwords, and explanation for codes and any other information has to be given whenever asked for. Further, no entry should be erased or overwritten. Incorrect entries other than those of clerical nature be scored out and under attestation, and thereafter correct entry be recorded. So there should be no scribbling. The entry has to be completely scored out, and again a fresh entry has to be passed. In case of electronic records being maintained, a log of every entry edited, deleted should be maintained, so that in future, whenever the officers want to check, they should also get this log to know if you have changed any entry after making the entry or deleted any entries from your records. Books of accounts maintained manually be serially numbered, and books are required to be produced on demand. Now, what will be the consequences if you fail to maintain the books as per the above requirements? The proper officer shall determine the tax payable on the unaccounted goods and service as if the same have been supplied. So whatever goods services are not found in your accounts, he will deem that they have been supplied and he will calculate tax. Provisions under 73-74 shall mutatis apply for determination of such tax. For what period the books have to be maintained? They have to be maintained for 6 years, that is 72 months from the due date of furnishing of annual return. So generally the due date is 31st of December of the next financial year. So from that 6 years, so every time generally until unless the due date is revised or shifted or deferred, the last date for closing or maintenance of this accounts will always be 31st December, because these 72 months are counted from the due date, not the actual date, but due date of annual return. Where an appeal, revision, or any other proceedings before any appellate or revision authority or an investigation is going on, 1 year after the final disposal of such appeal, revision, etc. So after this appeal is concluded, after that also until 1 year you have to maintain, or 72 months from the due date of furnishing of annual return, whichever is later. So 72 months is always there. But if besides that, if any matter is going on in the courts or in any appellate authority, then you'll have to continue with the records, and you have to retain the records even 1 year after the conclusion of that matter. Now we come to the second part, that is e-way bill. Firstly, let us understand what is e-way bill. So e-way bill is a mechanism whereby the government wants to track the movement of goods. So the government wants to track that if you are moving any goods from your place of business to any other place, that details should be with the government. Now, in order that you maintain the details, two things are there. First, whenever you start the movement, you have to report the details of the goods and the movement on the e-way bill portal, which is a separate portal. So one, you have the GST portal, one you have the IRP portal for e-invoicing, and this is the third portal for e-way bill. Now on this portal, you will be generating an e-way bill, which will be generated by the portal after you fill in all the details. And this e-way bill, the second step is the government has introduced the step of detaining a vehicle. Firstly, contra, what is the word? Means the GST law provides for the provision for first intercepting, not contravening, sorry, intercepting the vehicle, then checking the vehicle along with the details like invoice, e-way bill. And if any of the e-way bill provisions or the invoicing provisions are not complied with, detaining the vehicle and levying penalty as applicable. So this entire e-way bill mechanism is in two steps. One, you have to generate this on the portal, and two, physically on the road when your goods are under movement, the officers are empowered to stop a vehicle, intercept it, and if required, detain the goods and levy penalty. Now, the first step, that is generating the e-way bill. What are the provisions? So firstly, what is an e-way bill? So e-way bill is nothing but it is sort of an, you can say, a way of intimating the government electronically that boss, my particular goods, these detailed goods will be moving from this place to this place. So intimating them the movement of your goods is e-way bill. So how this is done? You go to the e-way bill portal. There are two parts of the e-bill. Part A is the invoice details. That is where the details of supplier, recipient, place of delivery, and the details of the goods, its HSN, quantity, value, GST, everything is uploaded. Part B of the e-way bill is about the transporter. So the medium of transport, the vehicle details, all these things are reported. Once you generate and upload part B, that is the transport details, then only the e-way bill becomes valid and the validity period starts. If you have only uploaded part A, which is now getting auto uploaded because of e-invoicing, it is not a valid e-way bill. So e-way bill validity starts only when you complete the second step, that is part B. Now, Section 68 read with Rule 138 are the governing provisions which provides for the procedure for entire e-way bill. Now, when is e-way bill to be generated? First requirement is there should be movement. Very important. E-way bill has no connection with supply. Entire GST law revolves around the concept of supply. E-way bill is the only provision which is not connected with supply. It is connected with movement. So whenever goods are being moved, whether there is supply, whether there is no supply, it makes no difference to the GST law. You have to prepare e-way bill subject to other conditions. Now, this movement of the goods could be in relation to your supply or for reasons other than supply. So even you are sending the goods on testing, you are sending the goods for approval, or it is only a branch transfer which is not a supply, whatever is the reason, you have to generate e-way bill. Similarly, if your supplier is unregistered, so you as a buyer, as a recipient also has to generate e-way bill for your inward supply. So basically, any movement on road should be backed up by an e-way bill generated through the e-way bill portal. If not, your goods may be detained and penalty may be imposed. Now, there is a monetary limit so that for all small value items, e-way bill may not be required. The value is 50,000. But what is important is the word is not transaction value or taxable value. The word is consignment value. Now you will say, sir, what is the difference? When you read the valuation chapter and you read the concept of taxable value, the taxable value is determined excluding the GST amount. Here, they have not used the word taxable value or value as per the valuation chapter. Here, they have used the word consignment value, which is defined to mean a value including the GST amount. So this is one big difference, that to check the e-way bill applicability of 50,000, you have to first add the GST amount. So there is a possibility that the value of goods is only 48,000. But after adding the applicable GST, the value exceeds 50,000, e-way bill shall apply. Now this 50,000 criteria is for interstate movement. If the movement is within the state is given the power to decide the limit, and many states have raised the limit to 1.5 lakhs, 2 lakhs in their respective states. But for all purposes, we will be considering the interstate movement limit of 50,000 only for all our discussion. Now, once these conditions are met, the registered person who is causing the movement. Now, what it means, so where supplier is doing the movement, the supplier has to raise. If the recipient is doing the movement, that is, recipient is arranging the transport for taking his goods, the recipient will be generating the e-way bill. Now, how it will be generated? You have to go to the e-way bill portal and fill in the details of your invoice in part A of the e-way bill. Now, exceptions to this 50,000, where e-way bill has to be generated even where the value is rupees 1. That is 50,000 criteria is not applicable. E-way bill is applicable across all transactions. What are they? One, interstate transfer of goods by principal to job worker, interstate transfer of handicraft by a person exempted from obtaining registration. In these two cases, e-way bill has to be generated even though the value is below 50,000. In all other cases, e-way bill is required only when the consignment value exceeds 50,000. Next, who causes movement of goods? So if the supplier is registered and undertakes the transport, the movement is caused by supplier. If recipient arranges the transport, movement is caused by the recipient. If goods are supplied by unregistered supplier to a registered recipient, movement shall be caused by the recipient known at the time of commencement. So these are how you will determine who causes the movement, that is who is required to generate e-way bill. Now, what are the informations to be furnished? Part A is furnished by the registered person who is causing the movement. Part B is generally furnished by the person who is doing the transportation. So if it is a outside agency or transporter, the transporter fills in part B. If you are doing transport by your own vehicle and you know that vehicle details, you will be filling in part B. Information in part A may be furnished by the transporter also if authorized by the supplier or recipient, or by the e-commerce operator courier agency if authorized, where goods are supplied through them. So many times I am the supplier, but I've given my goods to the courier agency, or my goods are going to be delivered through the e-commerce operator who is actually not the supplier. It is only the e-commerce operator. But since they are arranging the whole delivery, I authorize them to generate the e-way bill. In such cases, supplier recipient is not generating, somebody else is generating. Who can generate the e-way bill? It is to be generated by the consignor, consignee, or even the transporter. Where neither the consignor, consignee generates the e-way bill and the value of goods is more than 50,000, it shall be the responsibility of the transporter to generate, because ultimately the transporter's vehicle will be intercepted and the transporter will have a challenge. Other points, goods transported by railway shall be delivered only on production of e-way bill. E-way bill can be optionally generated even if consignment value is less than 50,000. So below 50,000, optionally also you can generate e-way bill, the portal accepts. Now, the details of conveyance may be furnished in Part B. In case of intrastate movement of goods up to 50-kilometer distance. Now, this is where Part B may not be generated. In short, the complete e-way bill may not be generated, only Part A is required. When is this relaxation given? So, when you are sending goods from your factory or your premises to the premises of the transporter, or the transporter is sending the goods from their premises to your premises. So many times at the time of transportation, you have to send the goods to transporter's office from where transportation starts. Or once the goods have reached the transporter office, the transporter will be sending the goods to your business place. For both these transports, your place to transporter or transporter place to your place, if this transport is happening within the state and it is within 50-kilometer distance, e-way bill part B is relaxed. Next, transfer of goods to another conveyance. Now, it may happen that while the goods are in movement, the conveyances are changed. This may happen either for completing the transport because the distance is long and one truck may not be going from one end to other end, so trucks are changing. Or second, because of some accident or some failure of the vehicle in between the road, you have to change the vehicle. In such cases, the vehicle details which were originally there in Part B has to be amended. So this should be done before the transfer takes place from one vehicle to another of the goods. Next concept is consolidated e-way bill. What is this consolidated e-way bill? So this is the responsibility of the transporter. This is required where individual e-way bills are not prepared. Why? Because individual consignments are below 50,000. But when all these consignments are loaded in one truck, the total value of transportation done in that truck is exceeding 50,000. Now the buyer seller is correct in not generating the e-way bill because the value is below 50,000. But if the total value of all consignments in the vehicle exceeds 50,000, it is the responsibility of the transporter to generate one consolidated e-way bill for all these consignments together. However, let me inform you, this consolidated e-way bill provision has right now not been notified, so it is not compulsory for transporters to prepare consolidated e-way bill. Cancellation. E-way bill can be cancelled by the generator within 24 hours and by the other party within 72 hours. So the person who has generated the e-way bill, for example, the supplier has generated. After generation, if he feels something is wrong, he can cancel the e-way bill within 24 hours. If 24 hours period is gone, then he can request the other party. So I'm the supplier, the other party is the recipient. The other party has the option to accept or reject the e-way bill within 72 hours. If he takes no action, it is deemed accepted. So within 72 hours, the recipient also has the power to reject. These are the two ways how e-way bill can be cancelled. Now, most important part. This e-way bill will have a validity period, which means after the e-way bill is fully generated, the transport should be completed within the specified timeline. What is the specified timeline? If the distance is up to 200 kilometers. Now, where the distance is up to 200 kilometers and the transport is not done in a large size truck, which is called as over dimensional cargo, then the validity given is 1 day for 200 kilometers. So for every 200 kilometers, the validity is 1 day. That is, the transport should be completed in 1 day. If let us say the total distance of transport is 300 kilometers. So first 200 kilometer 1 day and next 200 which is not completed. So any part is also one extra day. So it will be 2 days. So for every additional 200 kilometers or part thereof, we have one additional day. However, where the transport is to be done by an over-dimensional cargo, that is that long vehicles, which is called as over-dimensional cargo, or multimodal shipment in which at least one leg involves by transportation by ship, then 1 day, 20 kilometers, or for every additional 20 kilometers or part thereof, 1 day. This is the point of rejection I was telling you. So the other party has 72 hours to accept or reject. No action is deemed acceptance. Now, whether e-way bill is required in all cases? No. There are some exceptions, or you can say exclusions, whereby the e-way bill generation is excluded. So in those excluded cases, an e-way bill may not be generated. Next, documents or devices to be carried by person in charge. So wherever e-way bill is applicable, every transporter should carry invoice, bill of supply or delivery challan. Second, copy of e-way bill in physical form or the e-way bill number in electronic form or mapped to RFID, which is a device which is embedded in the conveyance except in cases of movement by rail or by air or by vessel. Now comes the second part. Now the first part is over where I, as the taxpayer, was required to generate. Now the second part is verification by the officer while the goods are on road, that is in movement. So when the movement is happening, the officer who is appointed or empowered by the commissioner may intercept the vehicle to verify whether the e-way bill is there and to confirm it with the details of the goods in the truck. So he can carry out physical verification of specific conveyance, and if he is receiving any specific information that there is some possibility of tax evasion, he can intercept the vehicle and ask them to allow him checking. Inspection. A summary report of every inspection of goods shall be recorded online on the common portal by the officer within 24 hours of inspection. So if he is inspecting any goods, then within 24 hours of inspection, he should report this on the online portal, and the final report containing all the details of inspection as to the number of goods which were found, whether matching with the invoice and e-way bill or not, all these things have to be uploaded within 3 days of such inspection. Once physical verification of goods being transported in any conveyance has been done during transport at one place within the state or in any other state, no further physical verification of the same vehicle is carried out again unless a specific information of tax evasion is subsequently brought to the notice. Where a vehicle has been intercepted and detained for a period exceeding 30 minutes, the transporter may upload the same information on the portal. So officer is required to give information of this inspection, but let us say he is not putting it the details on the portal. The transporter is also allowed to put the information on the portal. Restriction on furnishing of information in Part A of e-way bill portal. So in short, restriction on generating the e-way bill itself. So when the portal will restrict you from generating an e-way bill, firstly, no person, consignor, consignee transport shall be allowed to furnish information in Part A of the e-way bill in respect of outward movements of goods where being a composition dealer, the person has not furnished the statement for payment of self-assessed tax for 2 consecutive quarters. In short, he has not made payment up to 2 quarters, or being a person who is under the normal scheme has not furnished the returns of 2 tax periods, or being a person under regular scheme has not furnished GSTR 1 for any 2 months or quarters as the case may be, or being a person whose registration has been suspended. So all these people are disallowed by the portal itself to generate e-way bill. So this is just a precautionary measure because as you can see, these are the persons who are not paying tax or who are not filing returns. So they could be a possible tax evaders. Now, if they are possible tax evaders, why we should allow them to even do further transport? Because the more they are transporting goods, the more it is adding to the tax evasion amount. So to restrict them from generating e-way bill and thereby restrict them from doing more transactions and more tax evasion, the e-way bill portal is now so designed to block such people from generating e-way bill. Now we move on to the next chapter, which is the chapter dealing with payment of tax. Now, what is this chapter all about? So, whenever you have to make payment of tax, the question is, how is this payment made? So this payment is made by using the various ledgers in the portal. So the portal has various ledgers like liability ledger, input tax credit ledger, and the cash ledger. So using these ledgers, the taxpayer is required to discharge the tax. Now, firstly, some definitions are given. Now, what are the taxes to be paid? We all know for interstate supply it is CNS, for interstate supply it is IGST, and wherever applicable, he may have to even pay interest penalty fees or any other amount. Now, what are the features of the payment process? So firstly, you have to generate a payment challan. Now, this feature is common with all other taxation. Any tax payment has to be done using a challan. Now, what is unique about GST is right from day one, GST has been completely a system-driven taxation system. Now, in this system-driven taxation regime, you have to generate the challan also electronically, that is from the GST portal. So there is no option of using any physical printed challan. It is generated on the portal. Now, you can generate the challan on the portal by firstly logging into your portal, and from there, using that challan, you can make payment using the different modes of payment that we are going to study, which is physical mode also and online mode also. Now, as I mentioned, for making the payment, you require different ledgers. So what are these ledgers? These are electronic ledgers or e-ledgers. Why? Because they are maintained electronically. So these ledgers you can view, they are visible on your GST portal. So when you log into your GST portal, on that portal you find these three ledgers: the cash ledger, the liability ledger, and the credit ledger. So these are the three ledgers. Now, what is the cash ledger? So cash ledger is nothing but it is like depositing money with the government, or in other words, keeping money in the government account, which can be used for discharging your output tax liability. So what you do is you transfer whatever you feel would be the tax payment that you have to make from your pocket. See, one is you make the tax payment using the ITC. But if you feel that besides the ITC, you have to pay some tax from your pocket, so to that extent, you should, before the due date of tax payment, you should keep that much amount funded, deposited in this ledger, which is the electronic cash ledger. Now, what is important about this electronic cash ledger is that whatever you deposit or whatever is coming in this ledger through TDS or TCS becomes the deposit part. So either you can deposit it using various offline online modes, or whatever your supplier or the e-commerce operator has deducted, collected tax from you, that will be getting deposited here. Now from this ledger, the payments that will be made are payment of taxes, of interest, penalty, cess, etc. Now, how to deposit money in this cash ledger? You can use internet banking, you can use debit card, credit card, you can use UPI, NEFT, RTGS. Now, in all these, there is no limit on the amount that can be deposited. But where you want to deposit by going to bank and depositing using cash or check, the limit is 10,000 per challan per month. Now, this limit also has an exception, that where this payment is done on the advice of the officer, or where the officer has created the liability and he asks you to make payment, this limit of 10,000 in case of over the counter is also gone. But otherwise, where you are making self assessment and payment, this 10,000 limit is applicable. But this is applicable only when you go to the bank and try to deposit the tax amount using cash or check. For all other mediums, there is no limit of payment. Next, this cash ledger in the GST portal is divided into, you can say, you can visualize it like columns and rows. So the major heads is the tax. So it is IGST, CGST, SGST, UTGST, and the cess. And the minor heads that is under each heading, like under the IGST heading, you have the heading subheading of tax, interest, penalty, fees. Under the CGST heading, you have the subheading of tax, interest, penalty, fees, and so on. Now, So it is like a matrix where heading is of major heads and the rows is of minor heads. So under each major head, you will have all the rows. Now, when you are depositing money, you have to first create a challan. And in the challan, in this matrix, you have to fill in the amounts. Now, it is very important that you do it very meticulously, because if, let us say, you wanted to pay IGST tax, but you have put that figure in the CGST tax column or the CGST interest column or the SGST fine column, there will be challenge in utilizing that money later on to pay the IGST tax. In fact, even under IGST, if instead of tax column you have put the money in while creating the challan in the interest column, again, using that interest amount to pay tax is not allowed by the portal. Yes, there is a mechanism given by which you can internally transfer this money from one head to another. But then again, there is a process which has to be routed through portal. If the portal for some reason is not working, that internal transfer may not happen and your tax payment may get delayed. So it is recommended that whenever you are depositing money, kindly be very cautious while making the challan. Now, what will be considered as the date of deposit of tax dues? First, date of presentation, no. Date of payment, no. It is the date on which this amount gets credited in the account of the government. So only when the government receives the money, they will consider it as payment made, and not the date on which, let us say, many times what happens in online transaction, the moment you do the transaction, you receive a message from your bank saying that your account is debited. So you may feel that, okay, my account is debited, it means payment is done. No. If the amount has not been credited to government bank account for some reason, it may be technical error at the end of the bank. But for you and for your portal, it will not be considered as payment received by government, and consequences of interest and maybe penalty may follow. So you have to be very careful about this. The second ledger which you use for payment of tax is the credit ledger. Now, credit ledger is basically created through the GST of the suppliers who have supplied to you goods and services, of which you are availing the input tax credit. Now, when you avail this credit in your GSTR 3B, when you fill in the GSTR 3B column of availing the credit starts reflecting in your electronic credit ledger. Now, unlike the cash ledger, where you had major head, minor head, credit ledger only has the major head. So it is only the CGST, SGST, IGST, UTGST, cess. Because credit can come only of taxes. Credit cannot come of interest, penalty, fine. So by default, it will be only one major head, that is of taxes, because credit can come only of taxes. Now, what is very important in this particular point is the sequence of utilizing the credit. So let us say you have credit balance and you also have to make payment of tax. Now in this month, even you may have lot of credit balance in different credit columns of IGST, CGST, but the law has provided a strict mechanism of how you can use this credit to discharge your tax liability. Now, what is the mechanism given? So you have the input tax credit. The input tax credit would be of IGST, CGST, SGST, everything. You have to compulsorily start with IGST credit. This is the first strict condition. Second strict condition is this IGST credit should be utilized strictly for discharging your output tax of IGST. So input credit is of IGST and it has to be compulsorily utilized to first pay the tax of output IGST. If your output IGST is completely exhausted, that is your output IGST tax is completely done, and still you are having IGST credit, the law mandates that you have to first use it completely. Without completely using IGST credit, without making it zero, you cannot use the other credits. Now, after making payment of IGST liability, the IGST credit can now be used for C, S, or U. And here the law is liberal. It is saying you can do it in any sequence, any proportion. So you can use the entire IGST for C payment. You can use the entire IGST balance for S payment, or you can use it equally. You can use it 60/40. That is your choice. But that is only after you have completely paid the IGST liability. Now, if after utilizing the IGST credit for IGST and maybe to some part CS, now IGST is completely zero, but you still have payments to be done of CNS, then the second credit that you have to use compulsorily is of C. Now, C credit has to be first utilized for C. And let us say your IGST payment was balanced. After you have paid CGST tax, then only you can utilize the CGST for IGST. So when you are utilizing the CGST credit, it has to be compulsorily first used for CGST tax liability. After completely paying CGST tax liability, you can use for IGST tax liability. After CGST is fully utilized, then the last that you will utilize or you are left with is now SGST. Now SGST credit again has to be first used for SGST liability, and after the SGST liability is fully paid, if there is any IGST liability balance, that can be paid through it. Most important, CGST credit cannot be utilized for SGST liability, and SGST credit cannot be utilized for CGST liability. Now next is your liability ledger. Now what does your liability ledger includes? It includes all your payables, which may be towards tax, which may be towards interest, which may be towards penalties, fees, etc. Now, if you have multiple liabilities, in what sequence the liabilities have to be paid? Firstly, all your past dues have to be paid. Then you will come to your current dues, and thereafter the dues which are created by the department in any assessment. So firstly, you have to discharge your self-assessed liabilities, firstly of past periods. After that is completely paid off, self-assessed liabilities of your current period. And after that is completely paid off, liabilities created by the department when they have done their assessment. So this is the compulsory sequence given in which you have to discharge your output liability. Now, how will this liability be discharged? Now, as we discussed above, you have two ledgers. One is the credit ledger, one is the cash ledger. Obviously, you will be first utilizing the credit ledger, though there is no such mandate. You can pay the entire liability from the cash ledger also. But logically, every businessman would first like to utilize the credit ledger. Now, when you are utilizing the credit ledger, you should know that credit ledger contains only credit of tax. So by default, whatever is the balance in your credit ledger, that can be used only to discharge your tax liability, not interest, penalty, fees. So only tax liability can be discharged using the credit ledger balance, and that also in the sequence as we discussed above. Thereafter, when you are using the cash ledger balance, that balance can be utilized for all payments, that is for payment of tax, payment of interest, etc. So these are the three ledgers: cash ledger, credit ledger, liability ledger. This reflects all deposits that you have made either by yourself or it is coming from TDS, TCS, which the other parties have done. This ledger can be used for making all payments, maybe of tax, interest, etc. Credit ledger, this balance is created on the basis of the ITC that you claim in the 3B returns. On that basis, this ledger balance is created. And since ITC is only of tax portion, the credit balance in this ledger can be utilized only for discharging your tax liability and not any other. Third is the liability ledger itself, which reflects the total liability which you are required to pay in a month. Now, how the entries are to be passed? The entries will be passed in the manner. If you want to understand this, you have to first understand standard 11 BRS. Now, when we were doing BRS in standard 11, we realized that in our books, we have the bank balance or the bank account or the bank column. Similarly, the bank is also maintaining our details in their records. Now, interestingly, in our bank balance or the bank column of the cash book or in the bank account that we are maintaining, when we deposited money, we used to show it as a debit. But same thing in the records of the bank, whatever money we deposited in our bank account, they were showing it as a credit entry. Same logic you have to keep in mind over here. These are the records. These ledgers are the ledgers in the records of the government. So whenever you are depositing money in your cash ledger, whatever you are depositing in cash ledger, that amount is credited to the cash ledger. So amounts which are getting deposited in the cash ledger, either by your action or because of TDS TCS, which is claimed by you, that is credited. And when this balance is utilized to discharge your tax, whatever amount you have utilized to discharge your tax, that amount will be debited. Remaining balance can be carried forward, or if you want, you can get it refunded. Similarly, in your electronic credit ledger, also same thing happens. Whatever input tax credit you are claiming in the 3B, which is the self-assessment mechanism, that gets credited in this account first. And whenever you are utilizing it for paying the tax, this ledger will be debited against the liability ledger. Now, in case of liability ledger, whatever is the liability created for payment, that liability is debited over here. And when you are making payment of this liability through cash ledger or through credit ledger, that amount is credited here, because if you see, it is debited in the respective ledger. So in credit ledger, the amount that you are discharging the tax using the credit ledger is debited here, it is credited in the liability ledger. Similarly, whatever cash ledger amount you are utilizing for discharging the liability, it is debited in the cash ledger and it is credited in the liability ledger. So it is same simple, our debit credit entries only. But the only thing that you have to keep in mind is these are the records in the books of the government. So what we will be doing in our books, over there the entries are reverse. The debit credit is reverse in their books. Next is the portion relating to interest. Now, whenever you are making payment to government late, obviously there has to be some pecuniary interest for penalizing you for this late payment. This is provided for by virtue of Section 50 in the CGST and the SGST Act. What Section 50 is talking about, it says that if a person pays the unpaid amount on his own, the interest rate is 18%. Fine. Now, subsection 1 deals with what? Subsection 1 deals with late payment of your output tax liability. So whatever is your output tax liability, on that, if you are discharging that liability late, you have to pay interest. Now, the important point is how this interest is calculated. There are two mechanisms, or I will say there are two ways in which this interest amount is computed. One is on the gross liability, one is on the net liability. Now, what is gross? Gross is the total output tax. Net is total output tax minus the ITC balance that you have. That is the net amount which you have to pay through the cash ledger. Now, important is in calculating interest on the net amount, which is the amount that is payable through the cash ledger, is something which always a taxpayer would prefer. But the law has been so drafted that this benefit of discharging interest only on the net amount which you are going to pay through the cash ledger, this benefit is given only where you have reported a particular transaction in a month and that month's 3B itself is filed late. So taking for example, I have done transactions in the month of August, which I have to pay tax in the month of August. So I have reported in the GSTR month of August and I will be paying tax through the GSTR 3B of August. But this GSTR 3B of the August return, this return of August itself is deferred and I'm filing it in the month of November, that is late. Then I will be paying interest or calculating interest on the net liability. So in this whole return, let us say my gross liability is 1000, credit ledger which I can utilize is 600, and the amount which I have to pay through cash ledger is 400. So I will be computing interest for the period for which I am late for only 400 rupees, which is the net cash liability. However, when this benefit of netting is not available, let us say the transaction which is having the tax implication of 1000 is pertaining to the month of August. I filed the August return in time, but I forgot to report this transaction in the August return. So this transaction is pertaining to August. I report it in the return of October, which now I'm going to file in November. So in the October's return, which I will be filing in November, I report the transaction pertaining to August. Now, same thing, there is an outward transaction of 1000, there is ITC of 600. So effectively, I am required to pay the same tax of 400 only. But here, section 50 provides that the interest would be computed on the gross amount of 1000 and not on the net amount of 400. So when interest is computed on gross, where the transaction is reported in further months returns. So the transaction pertains to August, it is reported in October month's return. It is reported in January month's return. It is reported in March month's return. Even though there is outward and inward transaction both which are reported late, but interest is calculated on the gross, that is on the entire output without setting off the ITC. But where the entire return of August itself is filed in November, December, March, that is a return itself is delayed. And obviously in the return, both outward and inward transactions are there. In that case, the interest is computed on the net amount. That is the amount which you are required to pay through the cash ledger. So I hope you understood this very important difference about computation of interest. Now, next part in interest is where the interest is applicable on wrong ITC. So where I have claimed an ITC which is not eligible, this interest under 53 is triggered. Now here there was a amendment correcting this law. Originally this section only said wrongful availment, which meant that let us say I have taken wrong ITC of 500 in the August return. And for some reason, this 500 I did not utilize because there was no output liability in August, in September, in October. When I realized my mistake, I reversed this in November month's return. Now, as per the old provision, before amendment and correction, I was required to compute interest on this 500 for this 3 months period till the time I had availed it and kept it in my credit ledger. But logically, until and unless I have actually used it means set off it against my output liability, which is called as utilization, I have not led to any type of loss to the government exchequer. So I simply availing the ITC does not lead to any monetary or revenue loss to the government. So after a lot of representation, after multiple judgments, the law was corrected. And now the position given for computation of interest is that in case you have wrongly availed an ITC, like in my example, in August return, you wrongly availed 500, which is not eligible. Now this 500, if you have not utilized and you have reversed it in November, there will be no interest, because now interest under section 50 bracket 3 triggers when you do both wrong availment and also wrong utilization. So where both things are going wrong, you are required to pay interest. If only wrong availment has happened, but utilization has not happened, there is no requirement to pay interest. Let us say in this same example, out of 500, I utilize 100 in August, again 100 in September, again 100 in October. And then I reverse this entire 500 in November. Now, in this case, I will be required to pay I will be required to pay interest when I will be reversing this But again, I will be required to pay interest only on the amount which I have utilized and for the period for which I have utilized. So out of 500, I utilized 100 only in August. So from August to November, I'll pay interest on 100. I utilize further 100 in September. So for this further 100 which I've utilized in September, I will pay interest from September to November. So effectively from September onwards, I have to pay interest of 200. And if let us say further 100 I have utilized in October return, then for this third 100 which I have utilized in October return, I have to pay interest from October to November. So effectively from October, I have to pay interest on 300. So this is what is the effect of the new amended law. Next is TDS. Now, firstly, as I had mentioned earlier also, TDS under GST is not like the TDS under income tax. Under income tax, TDS is applicable on multiple transactions. Under GST, TDS is applicable only where the payment is made by government. So as you can see, who is the person who is eligible or liable to do TDS under GST? It is the central state government, local authority, governmental agency, or if any other person is notified. Now, when they are required to do TDS, if you have crossed the threshold, the transactions or the contract which you have entered into with government exceeds the threshold. What is the threshold? Total value of supply under a contract exceeds 2.5 lakhs, and this is excluding the GST portion. In simple words, if my supply value in aggregate is above 2.5 lakhs, the government will be deducting TDS while making payment of that supply. What is the rate of TDS? Under C and S, it is 1%, so total it is 2%. Now, no TDS will be deducted where the location of supplier and pace of supply is different from the state of registration of the recipient. Who is the recipient? Government. So if government is registered in some other state, the government cannot deduct TDS. Due date for payment of TDS within 10 days from the end of the month. So after deduction, the government has to deposit this TDS within 10 days from the end of the month. A manner of account of TDS by TDS deductor. The deductor, who is the government, needs to first get compulsorily registered. We saw this in the registration chapter also. They need to remit this TDS collected by the 10th of the next month, and the amount deposited as TDS will be reflected in the cash ledger of the supplier whose TDS was deducted. But this will be done only after they have properly uploaded this in the TDS returns. Manner of account of TDS by the supplier. Any amount shown as TDS will be reflected in your cash ledger. So when it is reflected in the cash ledger, you are given the option to accept or reject. So you should click on accept. The moment you click on accept, it gets added to your cash ledger balance. Until unless you click the accept button, it is not added. So you have to click that accept button when this TDS is reflected on your portal, and then it will get added to your cash ledger. Thereafter, you can either utilize it for discharging a liability, or if required, you can even get it refunded. So applicability of TDS situation. Supplier, place of supply, and the recipient, that is government, all are in the same state. So the TDS will be C plus S, and anyways, it is an intrastate transaction because the supplier and place of supply both are, let us say, in Maharashtra. Next, supplier and place of supplier in different states. It is an interstate supply. So obviously the government will deduct TDS of IGST. But this is interesting. Supplier and place of supply, same state, but the recipient is in another state. Now, even though it is an intrastate supply, so let us say supplier is in Maharashtra, place of supply of that contract is falling in Maharashtra, but the government who has given this contract is in MP. Now, this MP government cannot deduct this TDS. So, in short, for deduction of TDS, the recipient, that is the government, and the place of supply should be falling in the same state. Consequences if TDS provisions are not complied. So TDS, if not deducted by the government, interest to be paid along with TDS, else the amount shall be determined and recovered as per the law. TDS deducted but not paid to the government or paid later than 10 days, interest to be paid along with TDS unless action will be taken. Next, transfer of input tax credit, section 53 of CGST and 18 of IGST Act. Now, what is this dealing with? ITC of CGST used for payment of IGST. So we saw that after the ITC of CGST is used for CGST, if still CGST credit is left, and if there is some outstanding IGST liability, CGST will be utilized for discharge of IGST. Now, when CGST is used for discharging IGST liability, what will happen? Amount equivalent to ITC so used is transferred by the central government from the CGST account to the IGST account. So in government records, this transfer between various account heads is happening actually. Otherwise, their accounts at the end of the year will not tally. Next, ITC of IGST. When it is used for payment of CGST or where it is used for payment of UTGST, then the amount which is so utilized is transferred by the government from their IGST account to the respective C and UTGST account. Similarly, where it is used for payment of SGST, the amount equivalent to the ITC so utilized is transferred by the government from the IGST account to the respective state government's account. This is what many times you'll find that many state governments complain that they are not getting their share of tax from the government, which is this amount, that is the ITC, which is utilized, which the government may not have transferred. So students, these are the different points relating to payment of tax. Manish ji, it is around 8:52. Anybody of you is going to conclude this session? So do you want me to hand over the session to you?
No, sir.
No, no, so I can continue. Okay, so I'll go to another small chapter, which is e-commerce transactions. Now, firstly, who is an e-commerce operator? There is again a small confusion in this. So many times it is wrongly understood and interpreted by many that whatever transactions are happening through some portal, those come under e-commerce operators. That is incorrect. See, when the law uses the word e-commerce operator, law is talking about a third party portal. What do I mean by this? So let us say I am dealer of footwear. I have, let us say, Adidas brand of footwear in which I deal. Now, first possibility, I have my own website, my own business website, and you come to my business website and place order. Now, even though this transaction is happening through some electronic platform, which is my website, but here I or my website is not called as an e-commerce operator. Second, but this is an e-commerce transaction. Keep this in mind. So there is a difference between any transaction being an e-commerce transaction and any transaction happening through e-commerce operator. So I am trying to distinguish between e-commerce transactions with transactions happening through e-commerce operator. So firstly, what is e-commerce? E-commerce means supply of goods or services, including digital products, which is effected using some digital network. So we're using some digital or electronic network or some app, transactions are happening. That is e-commerce. But there are special provisions in the GST law for transactions through e-commerce operator. I'm trying to distinguish that. So when you are purchasing from my website, you are placing order on my website and I'm arranging delivery on the basis of this order. This will come under e-commerce transaction, but it is not a transaction through e-commerce operator. When it will be through e-commerce operator, I register my business on some online portal. Let us say I register myself on Myntra app, and you come to Myntra app. So you have multiple apps. You have Myntra app, you have the Prime app, Amazon Prime. So you have these multiple apps downloaded. So you like my shoes, which is uploaded or which is hosted on the Myntra app. You place order through the Myntra app. Now Myntra is a third party. So I am the supplier, you are the buyer. Myntra is a third party. Now when a transaction is happening through a third party app, that third party is called as electronic commerce operator. This transaction is also an electronic commerce transaction, but this transaction is also a transaction through electronic commerce operator. So this is what I'm trying to distinguish out. Now, who is this electronic commerce operator? Means any person who owns, operates, manages a digital or an electronic facility or a platform for e-commerce. And whenever we are talking about e-commerce operator, all the provisions under the GST law, which is applicable to e-commerce operator, you should remember we are talking about a third party app. So if the supplier or the recipient is having its own app and through that app they are doing business, it is an e-commerce transaction, but not a transaction through e-commerce operator. Now, what is the difference that you'll understand in this chart? So what is given? E-commerce, taxability and registration, where supplier supplies goods or services through e-commerce operator, that is through a third party app. So I will continue with my example. So I'm a dealer in footwear. I'm supplying the footwear of Adidas brand. I have my own website also, and I have posted myself on Myntra app. You are placing order through the Myntra app, then all this is applicable. If you are coming to my own website, my business website, and placing order, all this is not applicable. So let us understand. Supply of goods, ECO, supplier supplying through ECO. So firstly, the Myntra app. What the Myntra app has to do, it is required to obtain a registration compulsorily without any turnover limit. And the Myntra app is also obligated to collect TCS from me on my transaction value at the rate of 1%. So it will not make full payment to me. It will collect 1% of my TCS and it will deposit it in my name with the government. That is what is the obligation of Myntra app. Now, what is my obligation? I am the supplier supplying through the Myntra app, which is ECU. I am also required to obtain registration except where aggregate turnover of intrastate supplier within with enrollment number in preceding financial year and current financial year does not exceed the threshold limit. So if my transaction through this app within my state is below the threshold limit, no need of compulsory registration. But if through this app I'm transacting or I'm supplying the goods outside my state, then compulsorily I have to take registration irrespective of threshold. Next, whatever TCS Myntra app has collected and deposited in my name, that will be reflected on my portal. I will click, it will come to my cash ledger and I can utilize it for my tax payment. Next is supply of service. So let us say I am a service provider. I supply online, let us say I sell online lectures. And again, I have hosted myself on the Myntra app. Now, in this particular case, first, if there is supply of notified services through ECU, what are these notified services? It is the passenger transportation service, it is the restaurant service, it is the housekeeping service. So few of these services are notified. If any of these notified services are supplied by these apps, so giving you example of these services is Ola Uber, the most common one. Then for housekeeping service, I'm forgetting the name of that app. So there was an app which is for housekeeping service. So you require a maid, you require a driver, you require a cook, or any house help. You can get it from that app. I'm forgetting the name of that app. Okay, so these are the notified services. Now, if these services are supplied through this app, then 9(5), section 9(5) triggers, and the ECO, that is the app, is liable to pay tax in respect of these services, and the supplier is entitled to the threshold of 20 lakhs, 10 lakhs for registration as applicable. Next, now there are total 5 services, A, B, C, D, E. Now in case of A, D, and E services, ECO is always liable to pay tax. But in case of B and C services, ECO is liable to pay tax only if the supplier is not registered. So out of these 5 notified services, for 3 services, ECO is always liable to pay tax. But for 2 services, ECO will be liable if supplier is unregistered. Now, for these, where is that ABC details given? Okay. So here the ABC details are not given. So basically B and C is the hotel accommodation service and the restaurant service, and the remaining 3 services like the passenger transport, the housekeeping service, and one more service, they are in the A, D, and E category. So if it is ADE, then for ADE service, it is always the ECO who is liable to pay tax. But for hotel accommodation and restaurant, ECO is liable only if the supplier is not registered. Now, supply of services other than notified. So except these 5 notified services, for any other services, ECO, it is required to obtain compulsory registration. It is required to collect my TCS, and may not collect TCS if supplier is unregistered. So obviously it will be collecting TCS only if I'm registered. And for the supplier of these services, the supplier can get registered after the supplier crosses the threshold, and whatever tax is collected by the ECO will pay the tax, file the returns, and supplier will accept that tax, and it will come to the cash ledger of the supplier. Now, what are the provisions relating to TCS? So in case of e-commerce transaction, other than of notified services, wherever the transactions are happening through ECO, ECO has to collect tax. Now what is given? The tax collected is at the rate of 0.25 under CNS. So total it is 0.5. And person liable to collect tax is the ECO. There is no threshold limit. Value on which ECO will be collecting this TCS, it is the net value. What is the net value? Supply minus returns. And the due date of deposit of this TCS is same like TDS. It is the 10th day succeeding the month in which TCS is collected. What is the net value? It is the aggregate value of supplies minus returns. This is what is net value, and this is for other than notified service, because for notified services, anyways, ECO has to pay the tax. So students, with this, we have completed these 4 different chapters for revision. So we stop over here. The next topic for revision we'll be dealing with in our other class, and we'll be completing it then. So I request you all to kindly be in touch with your studies on regular basis. All topics are important, and some topics you may find difficult to remember, recall. So practice it more. And those topics which you feel are easy, pay a decent time so that you capitalize on those topics. So with this, I conclude today's session. So thank you very much, students. Let us connect again in the next class for the other topics. Good night. Yes, Manishi. Good night.